Hello everyone. Hello everyone. Can you please confirm if I am audible and visible? Can you please confirm if I am audible and visible? Can you please confirm if I am audible and visible? Can you please confirm if I am audible and visible? I will just wait for the confirmation. We'll just give it a couple of minutes before starting. Looks like we are audible and visible. We are live. Superb. Hello everyone. If you are an ACCA student planning to appear for financial management in the March 2026 exams or beyond, then this video is for you. Of course, this is the second video of this March 2026 batch. The first video is already uploaded on YouTube. But for those who are directly watching this video, just a brief introduction about myself. I am Divesh Harpalani, a chartered accountant by qualification, with an All India rank 6 and All India rank 13 in CA Inter and CA Final respectively. You can watch the orientation video of this batch or the previous video, which is the first lecture that is already uploaded on this YouTube video for more details. Once again, this is the second video. This is the second video or second lecture of this batch for financial management for March 2026 exams. We are discussing chapter number 3 today. Yesterday, we ended up discussing chapter number 2, which is investment appraisals. Chapter number 3 is also investment appraisals, but with discounted cash flow techniques, which is what we will be discussing today. So quickly, yesterday we ended up discussing the methods of ROCE as well as the payback period method. Like I had told you, each of these methods does not take into account the use of time value of money. This chapter has two specific methods, which is the net present value method NPV and the internal rate of return, which is the IRR method, both of which make use of the time value of money. But before we go into the details, let's just talk about what time value of money is. Before that, just a quick recap that these notes, each of my notes will have student guidance. The chapter will effectively have examples. It will also have practice questions which you all can refer to and you all can solve. Each of these chapters will have practice questions and examples which you all can refer to. There are also exam tip boxes that I have given wherever there are any specific exam tips. There are also these boxes that I have given. The notes, just as a recap, the notes already have all the concepts. If you are referring to these notes, you do not have to refer to any other notes whatsoever. These notes have all the concepts. There are also examples which are there within these notes. The solutions to these examples are also given at the back. There are systematically given all of these concepts, and if you refer these with all the sub bullets easy for you to remember, then there is no need for any other study notes. There are also practice questions, like I mentioned, given towards the end of these. Looks like there is a tech glitch. Not sure if my screen is super visible. Just checking. Hello everyone, hope you all are doing well. If you are an ACCA student planning to appear for financial management exams in March 26 or beyond, then this video is for you. Just as a quick reminder, this is is the second lecture of the March 2026 batch for financial management students of ACCA. The first lecture was already uploaded yesterday and is there on my YouTube channel, of course, open and free for all, whether you have enrolled for the batch or not. The first three videos, including today's, will be uploaded on my YouTube channel, free of cost, open for all. And of course, all the videos after that will be available only for the students who have enrolled for this batch. As a quick introduction, if you've not watched the previous video or the orientation video, I am Divesh Harpalani and I am a chartered accountant by qualification. Fortunate to have cleared with an All India rank 6 in CA Inter and with an All India rank 13 in CA Final. I also have close to 5 years of work experience in private equity and management consulting, which is where practically I ended up living and breathing all the financial concepts that we will be teaching and we've been learning as a student. Without further ado, let's just come to the concepts of the class for today. Today, we are going to discuss chapter 3, which is the investment appraisals using discounted cash flow methods. As a quick recap, chapter 2 was also investment appraisals, which had two methods, the ROCE method, which is return on capital employed, and the payback period method. Each of these methods, if you remember my yesterday's lecture, do not make use of the concept of time value of money. However, this chapter 3, which is using the discounted cash flow techniques, make use of the concept of time value of money. I had taken you through my notes yesterday. Of course, during the course of the lecture today, we will be again going through my notes. But just as a quick recap, clearly look out for all the examples which are there. There are concept-wise examples which are given. There are also practice questions that are given towards the end of the chapter, and there are solutions to the questions as well as examples which are given. As you can see, there are a number of these practice questions that are given at the end of the chapter that you can refer to. Coming back, there are also some of these exam tips and tricks that you will be finding throughout these notes, and if you refer to these notes, there is no other study notes that you need to refer to for ACCA. Of course, you can end up practicing additional questions from the ACCA study portal and the practice platform, but at least from a conceptual perspective, these study notes are enough. These study notes are enough for you. Having said that, without further ado, why don't we just get into the content directly? First of all, time value of money. Before we go into the details of the concept of time value of money, if I was to ask you this one question, which is, if I was to give you 1 lakh rupee today, or actually forget money, if I was to give you a piece of pizza today, and I was to give you an option of taking the same piece of pizza 5 years hence, what will you do? What is the choice that you will take? You will say, sir, I am younger today. I am your student today. If you promise me to get the pizza today, I know I will be getting it for sure. 5 years from now, I don't know if that pizza will still matter to me. Probably I would have earned enough for me to buy that pizza myself. That pizza would get stale in 5 years. I would have gained weight in 5 years. Sir, please give me the pizza today versus 5 years hence. The same is the logic with money. If I was to offer you to give you 1 lakh rupee today versus 1 lakh rupee 5 years hence, what will you choose? You'll of course choose the 1 lakh rupee today, because you will say, sir, if I take that 1 lakh rupee today, in 5 years that 1 lakh will become, let's say, 1.5 lakh or 2 lakh, because I will invest it somewhere and earn interest or understand any other return. This is nothing but the concept of time value of money, which says that money received today, the 1 lakh that you will be receiving today, is worth more than the same amount, the 1 lakh that you will be receiving in 5 years from now. The 1 lakh today is worth more than the 1 lakh that you will be receiving in 5 years from now. This is the concept of time value of money. Why does this happen? There are 3 reasons why this will happen. Number 1, the potential of earning interest. Where you came and told me, sir, if you give me 1 lakh rupee today, I will go and invest it somewhere else and I will make it 1.5 or 2 lakh rupees in 5 years from now, which is the 1 lakh today, if invested, can earn 5 years of compounded interest, and hence it is more than the 1 lakh in the 5th year of time. The 1 lakh today can be invested immediately, but the 1 lakh in 1 year's time or in 5 years time cannot be invested from today to earn that investment. So number 1, time value of money exists because there is a potential of earning interest. Think of it as you're paying rent to someone or you are receiving rent from someone to whom you are giving money for use. If you are giving money to someone for use, then you will be getting rent for the use of that money. That rent is called nothing but interest. Point number 2. Why is there a need for the concept of time value of money? Because there is inflation. The same pizza that is costing today, let's say 400 rupees, will cost much higher, let's say 800 or 900 rupees 5 years hence, because prices rise over a period of time because of inflation. The 100 rupees today, the 100 rupees today will buy more goods than 100 rupees in a year from now. You know, there's this famous WhatsApp forward or an Instagram post that you would have seen, that the price of a tea, which today some people sell it for 50 rupees, some people sell it for 20 rupees, was actually less than 50 paise back in the 1950s, and of course logically so. This is because the pricing power of money erodes over a period of time. The real returns that you will be earning when you invest in mutual funds, the real returns will exceed the inflation, that is there to maintain the wealth that you have. Which is, if you invest the 1 lakh rupee today for 5 years, let's say in mutual funds, and you earn 12%, that 12% will be higher than the inflation, which is 4 to 6%, depending on whether you look at nominal or real, and hence that inflation will also affect the concept of time value of money. Number 3, there is a risk that will be there. Let's say if your friend tells you, I will borrow money from you today and lend it or give it back to you 5 years hence. Is there a risk or not? There is absolutely a risk, because you will ask that question, will I even get back my money? So there is an element of risk. The longer duration, if he was to tell you, I'll give you the money tomorrow, you'll still probably take a chance and lend it to him. But if he today tells you that I'll lend you the money 1 year later, you might probably not even risk lending the money to him, because there is a risk element involved, which is why time value of money exists as a concept. The earlier cash flows are more certain than the distant ones. The earlier cash flows that your friend is committing to you to give it back to you tomorrow is more certain than his commitment to give you the money after 5 years, because you know, the closer there is the cash flow, there is a lower risk of you not receiving the money. The discounted cash flow techniques which we are using in this chapter, which we had not used in the previous chapter, the discounted cash flow techniques account for all of these 3 factors by using a discount rate. Now, a lot of people will ask me, what is this discount rate? The discount rate is also called a cost of capital or the required rate. In my example where I told you, you invest in a mutual fund which gives you 12%. This 12% is nothing but the interest that you will be earning. This is if you invest 1 lakh rupee today and receive a particular amount 5 years hence, and you discount it back to today using the 12%, which gives you back the 1 lakh, that is called a discount rate, which is also the cost of capital. Let me put it in other words. Let's say you are borrowing money from someone. Let's say you're borrowing money from a bank and you are investing in mutual funds or investing elsewhere. That cost of the borrowing, let's say you're borrowing money from the bank at 7 or 8%, that 7 or 8% is nothing but cost of capital. That is cost of capital. Now, let's talk about compounding of future value. Actually, before that, for you to remember the concept of time value of money, I will give you a very easy example which you'll 110% remember. Money today is like that date which your friend agrees to go with you tonight. But money tomorrow or money 5 years hence is like that WhatsApp message which he or she tells you, okay, probably I will see. What would you prefer? Of course, you will prefer the money today, or the date today, which is more certain than the date tomorrow or day after, which may or may not happen. Coming to compounding. What is compounding? Compounding is nothing but you saying, I will invest 100 rupees today. What will I get in a year's time? If you invest 100 rupees today, let's say in a fixed deposit, which gives you 8% return. If you invest 100 rupees today in a fixed deposit which gives you 8% return, how much of money will you get back in a year from now? You will get back 108 rupees in a year from now. Now, in a year from now, you'll invest that 108 rupees again in the same FD, which will give you how much? It will give you 8% on that 108 rupees. This is nothing but the concept of compounding. This is nothing but a concept of compounding. So compounding calculates what the sum invested today will be worth at a future date. What the sum invested today will be worth at a future date, considering the interest that you would have earned. Considering the interest that you would have earned. What is the interest over here? The 8 rupees in year 1 and the 8% on 108. What is the 8% on 108? 8.64. So in total, you will be earning 16.64 interest from a 2-year perspective. That 16.64% or 16.64 rupees on 100 rupees is nothing but the amount of compounded interest that you would have earned from a 2-year perspective. Now the formula is nothing but the principal that you are investing. The principal is nothing but 100 rupees that you invest today at an interest rate of 8% for n years. What is the number of years? In our example, the number of years is 2 years. So for 2 years, if you invest 100 rupees, the future value of those 2 years will be nothing but 100 into 1 plus 0.08 raised to 2. I guess what I am writing is not visible on the screen. Just give me a moment. Let me fix this. Let me just fix this. Perfect. So we are back. The example that I was giving you, just as a recap, we were discussing compounding and future value. Compounding is essentially what calculates the sum invested today. What will it be at a future date? In our example, we said if we invest amount of 100 rupees today, which is the principal, which is nothing but the amount that we invest today. P is nothing but the present value that we invest today into 1 plus 0.08, which is, what is 0.08? In our example, that is the interest rate that we receive. That is the interest rate that we receive from our investment raised to 2. What is n over here? N is equal to the number of periods. N is equal to the number of periods. So compounding, and if you solve it the other way also, there's 2 ways to do this. I say I get 100 into 108% for first year, which is 108 rupees. I will reinvest this 108 rupees for the second year, which will give me 116.64. The easier way to do this is to do 100 bracket 1 plus 0.08 raised to 2. Now if I was to do 1.08 square, this will give me 1.1664. So 100 into 1.1664 will give me 116.64, which is the same number as this. This is nothing but the concept of compounding and the formula of compounding. Let us take an example. The example is, if you invest 100 rupees today at a 10% interest for 2 years, what is the future value? If you invest 100 rupees today at an interest rate of 10%, this is nothing but 10% for 2 years, what will this amount be? So there's two ways of calculating this. One, I will say I invest 100 rupees plus the second year I earn 100 rupees into 10%, which is 10 rupees. So first year I will earn 10 rupees. The next year I will invest this 110 rupees. So I will earn 110 into 10%, which is nothing but 11 rupees. So my total earnings will be 100 plus 10 plus 11, which is 121 rupees, The other way to do this is using the formula that we studied, which is the principal amount. Future value is nothing but the principal amount of the present value into 1 plus the interest rate or the discounting rate or the required rate or the cost of capital, whichever way you look at it, which is R raised to n. And this number is nothing but 100 into 1.21, which is 121. This is the base meaning of the concept of compounding. So how do you use compounding? If you were to invest money for 5 years at an interest rate of 5%, what is 5 years over here? N is equal to 5. N is the time period, N is number of years, which is 5. What is 5% over here? 5% is nothing but R. So in our formula, if we were to put this, we will say what is the present value? 1 rupee. What is the interest rate? R is 0.05. And what is the time period N? It is 5 years. So what is the future value? The future value is 1.276. If you do this using a calculator, which is 1 plus 0.05, it gives you 1.05 for the first year. And the math trick over here is, the calculator trick over here is, you just keep pressing equal to. The second time you press equal to, so actually you should do 1.05 into 1. The first time you press equal to, it is 1.05. The second time you press equal to, which is the second year compounded rate, it is 1.10. The third time you press equal to, it gives you the third year. Keep going for 5 times, and the fifth time it will give you a number of 1.276. This is how you calculate the compounded return. So for 5 years, 5%, it is 1.276. And if you keep doing the same thing for 10 years, you will get a number of 1.67. What does 1.629? What does this mean effectively? It means that if you were to invest 1 rupee today, at 5% for 10 years, at the end of 10 years, you will get 1.629 rupees. This is the concept of compounding. And you would have also seen a lot of those Instagram posts, especially on the new year. Now that the new year just went past, you would have seen a lot of those posts which say 1 raised to 365. 1 raised to 365 is 1. 0.99 raised to 365 is much lesser than 1. But just 1% extra if you give every day, this is much, much higher. So compounding works fast. Think of it this way, that you are going to a gym. Will you see the impact on day 1? The answer is no. You'll hardly see any impact on day 1. But you'll start seeing impact over a period of time, and that is nothing but the concept of compounding and future value. What does this mean? That the future value is much higher than the present value today. How much higher is it will depend on your R, and in what period of time, that depends on the N. That is the concept of compounding. Let us talk about the next concept, which is discounting. Discounting is exactly opposite to compounding. If I was to make a timeline where I say here is where you are today, which is year 0. Today, this is you today. you in 1 year, you in 2 years, 3 years, 4 years and 5 years. Correct? In the 5th year, in the previous example that we discussed, if you were to invest rupee 1 today at 5%, in the 5th year, you will be at 1.276 rupees, which means the money is getting compounded. But if I was to ask you other way, what is the value of the 1.276 which I will get in 5th year? What is the value of that 1.276 of future value today? What is the value today? The answer is rupee 1. So this process where you go from 1 rupee to 1.276 is compounding, and this process where you come back from 1.276 to rupee 1 is called discounting. So discounting is nothing but the reverse of compounding, where it calculates what the future sum. What was the future sum? 1.276. What is it worth in today's terms? It is worth a rupee 1 in today's terms if you discount using 5%, which is your discounting rate, which is also called as the cost of capital, which we will study in the future chapters. What is cost of capital? How is it calculated? Which we will be studying in the future years, future chapters. And it is also called rate of return. Present value is nothing but the cash equivalent today. This is the cash equivalent today of the money receivable at a future date. So this is the rupee 1 that you will be getting today if you were to invest the 1.276, if you were to get the 1.276 5 years hence. What is the formula? And just ignore this formula, just think of it as reverse of compounding. What is compounding? Compounding is nothing but future value, which is present value, into 1 plus rate raised to n, where n is the time period. Present value is nothing but the reverse of, if you were to take present value over here, and if you were to do the formula, then it is nothing but 1 plus r raised to n divided by, or the future value, if you were to actually do the math, then your present value is nothing but the future value divided by 1 plus r raised to n, is 1 plus r raised to n, which is, if you take the equation this side, then it is 1 plus r raised to n, or the other way to put it is, if you were to take this up, then it is raised to minus n. This is the formula of discounting, which is exactly opposite that of compounding. So what is PV? PV here is the present value, F is the future value, R is the discount rate, N is the number of years. And this, in our example, this was the 8 rupee example that I gave you, the 8 rupee example that I had given you. This is nothing but the discounting factor. This is nothing but the discounting factor. So what is the discounting factor? The present value, if I was to receive 1.276 5 years hence, if I was to discount it using 5%, for 5 years, this is minus 5. If you were to discount it by 5% during 5 years, and how would you do this discounting? So just do this with me on your calculator. 1 divided by 1.05. This is what the value of 1 rupee will be in a year's time. What did I tell you when we were discussing time value of money? That the money received today is worth more than the same amount received in future. So if you were to receive 1 rupee today, and if you have the discounting rate of 5%, how much will you receive in a year from now? You will receive 0.952, which is 1 divided by 1.05. This is for year 1. If you keep doing this for year 2, you just have to press equal to on your calculator, then the number will be 0.907. If you keep doing equal to for the 3rd, 4th and 5th time, for year 5, this number will be 0.7835. And if you now multiply 1.276 into 0.7835, if you do this, then the answer will be nothing but rupees 1. exactly the reverse of what we did over here, where we took 1 rupee. From 1 rupee today we multiplied and reached future of 1.276. You just have to bring back the 2762 rupee one today. So now the same thing that I had mentioned, what is the value of the rupee one in 1 year from now? If you discount it using 10%, just do this again with me because you'll have to do the practice on your calculator. Of course, in exams, you'll have the benefit of spreadsheet. Do 1 divided by 1.1. The answer is 0.909. What does this mean? That in a year from now, the 1 rupee today will be value only 90.9 paisa. And if you keep doing this, if you press equal to again, for the second year, third year, fourth year and fifth year, basically you press it total 5 times, then you reach 0.621. So the value of 1 rupee today will be 0.621 at the end of 5 years using a discounting rate of 10%. And if you keep doing this for 10 times, then this number is 0.386. Effectively, what this means is, now if you compare the discounted number over here versus over here, if you see the rate of discounting over here was 5%. At 5%, the discounting factor was 0.7835, but at 10% the discounting factor is 621, because 10 is higher than 5, which means your amount will keep reducing fast if the discounting rate is higher. Now the discounting rate is higher, which means the compounding rate is also higher, which means if you invest 1 rupee today, you will get much higher tomorrow. But that same much higher tomorrow, if you bring it back today, then it will be much lower, which means if there are higher discounting rates, then the present values are smaller. In other words, to get the same 5 lakh rupees in 5 years, you will have to invest lesser money today. If you're investing at an interest rate of 10%, you'll have to give more money if you are investing at an interest rate of 5%. Or if the period is longer, just logically think, keep aside the formula and the math over here. If you were to choose between an FD rate, which is giving you, bank is giving you 7%, and a mutual fund which is giving you 12%, and I was to ask you, if you invest 1 lakh rupee today, in 5 years from now, what investment will give you higher amount of money? And I'm sure all of you will say the 12% that the mutual fund, which is the higher discount rate, will give me a higher future value. If it is a higher future value, it means a lower present value. You will have to invest a lower amount today. Similarly, the 1 lakh rupees will take more time to reach 2 lakh rupees if you are investing at 7%, and it will take less time to reach 2 lakh rupees if you are investing at 12%. So if the period is longer, then you'll have to invest smaller amount. If the period is longer, think of it as this example where your money, or let us actually take this example where your money will in 10 years from now have a value of only 0.386. The same 1 rupee in 10 years will be only 0.386, versus in 5 years it will still have a value of 62 paise, and in 1 year it will still have a value of 90 paise. So the longer you keep it, the present value will be smaller. Let us solve another example. What is the present value of the 1,15,000 that is receivable by you in 9 years at a discount rate of 6%? I will write down the formula for you. The formula is nothing but, for discounting, present value is equal to future value into 1 plus rate, which is discounting rate, raised to minus n, right? Effectively, what this means is, in our example, the present value is 1,15,000 that is receivable in 9 years. The 1,15,000 is not the value that you have today. It is what you will get in 9 years from now. If you use that math, then it is 1,15,000 the future value into 1 plus. What is the rate? It is 6%. It is 6%, which is why I'm writing 0.06. 6 divided by 100 is 0.06 raised to minus n. What is n? It is 9. How do you do this mathematically? You will use your calculator. Pick up your calculator. Just say 1 divided by 1.06 equal to, the first year answer is 0.9433. second, third, fourth, fifth your answer is 0.747, but you have to keep doing this for 9 times. So 6, 7, 8 and 9. Your ninth year answer is nothing but 0.59189, and if I was to multiply this by the 1,15,000, the present value is 68068. What does this mean? This means that if you were to invest 68,000 rupees today, for 9 years at a discount rate of 6%, you will get 1,15,000 at the end of 9 years. Now, in examination, actually, you can either use the spreadsheet that will be provided to you. Towards the end of this lecture, I will also show you how to use the spreadsheet. Actually, why don't we do that for one of the NPV and IRR sums, where I can show you how to use the spreadsheet formulae. But right now, there's a present value table also that you will be giving in the exam, which is there at the end of the chapter, and I can show you how to use the present value table. Just remember the example that we had, which was saying 9 years. So this is the present value table. This is the present value table which is given at the end of the chapter. This is an annuity table which we will come to. What does this say? At the end of 9th year, if you were to discount at 6% in our example, 6% in 9th year, your value will be 0.592, which is very close to what we have. We had 0.59189. This has 0.592, which is slightly rounded off. So in the examination, you can also use the present value tables if you don't have to use the calculator. But it is very, very important to know how to use the calculator if it comes to it. However, if you were to use it, this is how you will end up using it. Coming back, this is how present values are calculated. Coming to cost of capital. Now, I did mention that the discount rate is also equal to the cost of capital or the required rate of return. A lot of you will ask this question, what does cost of capital mean? While we will study this in detail in the chapters to come, for now, cost of capital is also called discount rate or required rate or hurdle rate. Just remember these names. It is also called discount rate, hurdle rate or required rate. What is this? This is the minimum return that the firm wants to earn on their investments. Think of yourself as a shareholder in a company. You've invested in a company and you want to, let's say for example, earn 10% return for sure. That is the minimum you want to earn, because you would have earned 9% in an FD either which ways, and hence you say I want to earn 10% return if I make investment in this company. That 10% is the minimum rate of return that you want to earn, or that is the opportunity cost. Let's say if an FD was to give you 10% as well, that is the opportunity cost of tying your capital. If not in this company, I would have invested in the FD, right, which would have anyways given me 10%. Then I would much rather invest in FD. If it has either ways 10%, why take a risk? You will invest in this company only if you're getting more than 10%. So over here, your cost of capital is 10%. The other way to look at it is your cost of financing the investment. Let's assume you don't have the money. You go and borrow from your friend, or you go to the bank and you borrow from the bank and say, you lend me money at 10%, I will give you more than 10% return. So this is nothing but the cost of financing the investment. And this effectively means the rate that you use to discount the future cash flows. Remember, I said year 1, year 5. When you bring the cash flows from year 5 to year 1, this is called discounting. The rate that you use for this discounting is nothing but cost of capital or discounting rate, or rate of return, or the hurdle rate. This summarizes the concept of time value of money, compounding, discounting, which by the way is the entire base of financial management. All the concepts invariably are somehow linked to the concept of time value of money. And what does the time value of money say? Remember, it says that the WhatsApp message saying let us go for a date today is better than the WhatsApp message which will say let us see tomorrow. So the money today is worth more than the money that you will be getting tomorrow. That is the concept of time value of money. Let us go to the NPV method. In the past chapter, again, we had studied two concepts of evaluating investments. One concept was the concept of return on capital employed, where we use the accounting profit versus the initial capital or the average investment that we had made. That percentage is nothing but the return on capital employed. The other method that we had studied was the payback period method, which is in how much time period will you get back the money that you would have invested. That is the concept of payback period. This is the third concept of evaluating investments, which is the net present value method, which makes the use of discounted cash flow techniques. What is the NPV method? It is used to appraise the overall impact of a project. It is used to decide whether you should invest in a particular investment or not. And like I mentioned, it uses the concept of discounted cash flow. What was this? Year 5 money, year 5 money, year 4 money, year 3 money. This is nothing but cash flow. Discounting it to year 1 is discounted cash flow, which involves discounting of all the relevant cash flows. In the last chapter, we had also studied relevant cash flow, where I told you if you go on a dinner date and you've already prepaid for the dinner, then that dinner, the amount that you've paid is irrelevant irrespective of whether you get a yes or a no. If you've already paid 500 rupees for a movie ticket, then whether or not you like the movie, that 500 rupees is irrelevant. But if you decide whether to buy popcorn or not, that is a relevant cash flow, because that is a future cash flow, that is incremental cash flow, something that you have not incurred yet. This is what we studied in the previous chapter, which is chapter number 2. NPV is nothing but the sum of all present values of relevant cash flows. Now leave the formula aside. Let us just use a practical example. Let's just say I tell you, if you do ACCA, in year 1, your salary will be 12 lakhs. In year 2, your salary will be 14 lakhs. In year 3, your salary will be, let's say, 15 lakhs. Year 4, you get a very big promotion. Your salary becomes 25 lakhs. Year 5, you end up earning another promotion. You end up earning 35 lakhs. Arbitrary numbers. The numbers are actually much higher. Then every year will have some cash flows. What is the present value? If I was to ask you, what is the present value of you doing ACCA today, you will discount all of these to your year 0 cash flows. What is the discount rate that you will use? We'll discuss in the future chapters, but let's assume you simplistically use a discount rate of 10%, then effectively discounting all of these cash flows to year 0, which is to the present value. This is the concept of NPV. So the formula is also nothing but cash flow at T. What is T? T is the time period. T is the year. So the cash flow at year 1, for example, which is 12 lakh, divided by, what is our rate of return? 10%. So 1 plus 0.10 raised to T. T over here for first year is 1, plus second year you said you earn 14 lakhs. Same 1 point, this is L, 1.10 raised to 2 for second year, and so on and so forth. Fifth year will be 35 lakhs divided by 1.10 raised to 5. So the total of all of this is the symbol of total. The total of all of this is the present value of you doing ACCA today. This is the example. Now, how does the method of NPV help you out? Effectively, if this answer, let's say you have spent 1 crore in doing, and of course you won't spend 1 crore, but let's say hypothetically, if you would have spent 1 crore in doing ACCA today, this method will help you decide whether your present value is greater than the 1 crore or not. Whether your present value is greater than the 1 crore or not. If it is greater than 1 crore, then does doing ACCA make sense? Yes, because it is more than what you had invested. If it is greater than 0, then you should accept it because it earns surplus. Think of it as you have taken a loan from the bank at 10%. You have to pay the money to the bank at 10% return. You will invest in a particular investment only if it gives you more than 10%. And only in that case, you will accept. If it is zero, you will say it doesn't matter because bank gave me money at 10%. I have earned 10% money. So it doesn't matter. I can choose to invest or not invest because I'm break even at this number. But if it is less than zero, which means if the bank gave you money at 10%, but somehow you invested and you got the money at much lower, will you invest? You may choose not to invest. You may choose not to invest. So that is a example. That is how we will do using NPV. Let us look at a practical example. The practical example is if your cost of capital is 97,000, if your cost of capital, or actually your cost of capital is 12%. In our example, the bank had given money at 10%. Over here, let's say the bank has lent you money at 12%. If the cost of capital is 12% and NPV is greater than 0, NPV is greater than 0, NPV is greater than 0, then you are getting 97,000 NPV at 12% cost of capital, which means if you have borrowed the funds at 12%, you will be 97,000 in the pocket. This is the exact profit, the surplus over the cost of capital that you will be receiving. This is the surplus over the cost of capital that you will be receiving if you were to invest. If it generates, that is the investment generates 97,000 more than the minimum required return. At 0, you would have earned exactly 12%, and at less than 0, you would have earned less than 12%. But at 12% cost of capital, you are making a 97,000, which means your shareholder wealth has increased. Your wealth has increased by 97,000. Your wealth has increased by 97,000. For multiple projects, when you were to decide whether to choose project A or project B, which is in our example, project A is FD, project B is mutual fund. Now, for example, the bank lends you money at 10%, FD gives you 7%, mutual fund gives you 12%. What will you choose? You'll of course choose mutual funds because at 12%, which is greater than 10%, your NPV is positive. It is positive. So in case of multiple projects, you go ahead with the project which has the highest NPV, even if both are positive. Let's say one project has a 10,000 positive NPV, another project has a 30,000 positive NPV. What makes you more money? Of course, 30,000 rupees is higher, and hence you will choose that project. Actually, not the highest return percentage. It doesn't matter what the return percentage is, because think of it as one friend of yours says, I have earned 100% return. I have earned 100% return. And another friend says, I have earned 15% return. Intuitively, you will say friend 1 is better than friend 2. But later the friend 1 comes and says, oh, I have earned 100% return on rupee 1. And this second friend has earned 15% return on rupee 1 lakh. So this gentleman has earned 15,000 rupees and this gentleman has earned only rupee 1. So what will you choose? You'll of course choose 15,000, even if 15% is lower than 100%. So you choose the one which has the highest possible NPV, highest positive NPV in an absolute amount and not as a percentage. If there are mutually exclusive projects. What does mutually exclusive mean? That project A and project B are very different. Either you will undertake project A or you will undertake project B. You will not undertake both. These are two very, very distinct projects. Which is, for example, FD and mutual fund. You will either invest in FD or you will invest in mutual fund. Another example. Let us solve this example from a NPV perspective. There are cash flows. So cash flow, by the way, what does year 0 mean? Year 0 effectively means today. Today is year 0. Year 0, if you're standing today, the time period is 0. Let's say today is hypothetically 1 Jan 26. 1 year from now will be 31st December 26 or 1st January 27. That is the year 1 mark. That is the year 1 mark. Today is year 0. This is the year 1 mark. Today is year 0. So let's say you are, whenever a cash flow is given as negative, it means you are investing. You are investing. So if you invest 25,000 today behind buying the lectures, which are by the way much cheaper than 25,000, but if you invest 25,000 behind buying the lectures, you will get a return of actually much higher. You should add a couple of zeros here, or in fact more than that, but you will get back so much. What does this mean in terms of NPV if the cost of capital is 6%? Let us solve this. So year 0, what is the amount? What is the amount? What is the amount or the future value? This is the future value. What is the amount in present value? What is the amount in present value? So at year 0, your amount is, or actually we should put over your discounting rate. If you remember, the present value is nothing but future value into discounting rate. So discounting rate into future value gives you your present value. So if this is A and this is B, A into B will give you your present value. So your year 0 is 25,000, but sir, 25,000 is not future value, it is present value. I am investing that 25,000 today. Yes, and hence the discounting rate is 1 rupee. The 25,000 rupees that you're investing today, how much is it worth today? It is worth 25,000. It is worth 25,000 today, and hence the discounting rate is nothing but 1. In a year's time, you will get back 6,000 rupees. What is the discounting rate for year 1? It is nothing but 1 divided by 1 point. What is the cost of capital? 0.6, because it is 6%. This is raised to 1. This is raised to 1. Use your calculators. Say 1 divided by 1.06. This is 0.943. This is nothing but 0.943. This is 0.943. So what will your present value of the 6,000 be that you will be receiving in year 1? It will be 0.943 into the 6,000 rupees, which is 5660. In year 2, you will be receiving an amount of 10,000 rupees. You will be receiving an amount of 10,000. Again, 1 divided by 1.06 equal to is 0.943. Press equal to again, and that will give you the second year rate, which is 0.8899. Press equal to again, and you will get a rate of 0.8396, which is your year 3. Press equal to again, you will get a rate of 0.792, which is your year 4. If I multiply the 10,000 into 0.8899, what is my second year cash flow? My second year cash flow is 8899. If I multiply 8,000 into 0.8396, this is 6717 approximately. If I multiply 0.792 into 7,000 that you will be receiving in 4th year, it will be 5544. So these are the positive cash flows that you will be receiving, but this is the present value of those cash flows. Now if I was to add all of these cash flows, 5660, 8899, 6717, 5544, then the total amount is nothing but 26820. But you'll also have to subtract the amount that you are investing today. You'll have to subtract the amount that you're investing today, and hence your present value is approximately 1820. This is a positive NPV. This is a positive NPV, and hence if we go back to the decision making mechanism, if it is positive, you should accept the project. If it is positive, you should accept the project. Before we go for a break in the next 2 minutes, I just want to show how to do this on a, I would just want to show you how to do this on a calculator. I just want to show you how to do this on a calculator. Just give me a minute until or actually how to do this on an Excel, on a spreadsheet. I will just show you a spreadsheet. Let us do this live together, because in the exam you'll have to use a spreadsheet. So in the spreadsheet, you will do the same thing here: future value, discounting rate, and present value. Your year 0, 1, 2, 3, and 4. Your future value for year 1 is 25,000, which is also your present value, For year 1, it is 6,000. For year 2, it is 10,000. Year 3, it is 8,000. Year 4, it is 7,000. What did we do over here? The discount rate for year 0 was 1. For year 1, the discount rate was nothing but 1 divided by 1.06, because 6% was your cost of capital. Now you will divide this, which is the first year discounting rate, you will divide by 1.06, because in year 2, the value of the rupee 1 in year 1, which is already 0.943, will come down, and you will keep doing the same thing. Again. I am pressing Ctrl D, so the same formula will come down. Now your present value of each of these cash flows is nothing but the discounted rate into future value. I am again doing Ctrl D. This is nothing but Ctrl D. I will show you the formula as well. The formula is the same. And just adding all of these value, which is 1821. Our answer was 1820 because of the minor rounding off. 1820 is your NPV. Now what I wanted to show you is this. NPV is a formula in the spreadsheet as well. How do you use this? You say, what is the rate? The rate or the cost of capital is nothing but 6%. 6%. Let us redo this. Is nothing but 6%. And what is your value 1? Value 1 is this, value 2 is this, or you can also drag it down to say your value is C5 to C8, which is year 1 to year 4. This is the total present value, which we had also calculated at 26,800 of all the future cash flows, and from this you will reduce the amount that you have invested today, which is 25,000. So using the NPV function, you can easily calculate without doing the math, which is NPV rate, which is 6%, all the values, but make sure the values start at year 1, not at year 0. Year 0, you will separately add the value, which is 25,000, and this gives you your NPV. This summarizes our net present value as a concept. Again, before you go for break, why don't we complete the concept as a whole? So let's discuss the advantages and disadvantages of using the net present value method. The advantage is that, and if you remember, the ROCE and the payback period both had this one disadvantage, which is they do not make use of the time value of money. But NPV considers the time value of money. It considers the fact that money today is worth more than money tomorrow, and hence it discounts. If you remember, what were the three factors in time value of money? Interest, inflation, and risk. And hence it is superior to payback and ROCE. Which had this as a disadvantage, and hence NPV distinguishes between 100 rupees today and 100 rupees in a 5 years time, because 100 rupees in 5 years time is much lower than 100 rupees today. It is an absolute measure of return. If you remember, both payback period, which give you a period of time in which you'll get back your money, as well as ROCE, which was a percentage term, did not talk about how much of amount do you earn from a particular investment, but NPV tells you how much amount will be added to your wealth, how much amount will be added to your wealth. And this is not just a percentage, it gives us a clear prioritization. What is the objective of financial management? The objective of financial management is to maximize the wealth of the shareholders, and hence the absolute measure of return NPV will help you maximize the wealth of the shareholders. It is based on cash flows. It is based on cash flows and not profits. If you remember, the ROCE method was the only method that was based on profits. All the other methods, including the payback period, are based on cash flows. And I had given this analogy to you in the last lecture as well, that profits are just opinions, but cash flows are facts. Profits are just opinions. Profits are like the promise by your parents to give you 20,000 rupees next month. But cash flow is factually what you have in your hand today. So it uses the actual cash movements. It uses the actual cash movements and it avoids the accounting distortions. If you remember, there are ways in which the profits will be different for the same company if there are difference in depreciation methods, and hence, because this is based on cash flow, it is more reliable from a decision making perspective. It considers your whole project life. If you remember, payback period used to consider only the time period till that payback period, and hence it includes all the relevant cash flow from start to finish, unlike the payback. Payback period is only concerned about when you get your capital back, even if after that you don't earn any particular money, or you earn 1 million in the example that we, and hence this gives you a complete economic impact evaluation, which is the best in case of an investment appraisal. In investment, what are you evaluating the most? As to how much wealth will you make over a period of time? How much wealth will you make over a period of time? And hence it supports shareholder wealth maximization. The higher the NPV, the higher the positive NPV, the higher the shareholder value. This is the decision rule that aligns with the corporate objective. What is the corporate and the financial management objective? The objective is to maximize the shareholder wealth. Disadvantages of NPV. Of course, everything in life has advantages and disadvantages. You are liked by your parents, but there is always something that is missing, and there is always some or the other thing that your parents keep telling you that you need to improve. Similarly, every method, including the one that is the best suited for making investment appraisals, also has a disadvantage, that it is difficult to explain to non-financial managers. But my students will not find it difficult, because we've clearly done the examples in the class, and we have also studied the concept very well conceptually. However, for non-financial managers, it requires the understanding of what discounting is, which is not very intuitive. Unlike ROCE, which was very, very intuitive. Payback in 3 years is intuitive and 20% return is intuitive, but 500 lakhs, for example, which is 5 crores, 500 lakhs as NPV is not very, very intuitive, and hence from an operational manager perspective, it may face some resistance. It requires calculation of cost of capital, but sir, the question already gives us the cost of capital as 6%, 8%, 10%. This is because this is already calculated by the institute before giving it to you. However, in real life, this 8% or 6% needs to get calculated, and the calculation requires a lot of accuracy. Otherwise, the investment decision may prove to be inaccurate, and hence, which is complex. And even a minute difference of 8 versus 9% can reverse a marginal project decision. If the decision is very marginal, which is a very on the margins, on the boundary decision, then even this 1% may reverse the decision of the project. The calculations are complex. while the concept is easy and all of you have already understood the concept, you will realize that payback period was very easy. You get X amount every year, just divide the total amount that you've invested by that X amount and you will get that number. But over here, there are multiple steps that are involved. You'll have to press equal to on the calculator for 10 times to get the 10th year discounting rate, which is not complex, which is easy, but at least it is more time consuming than the basic method. And it requires spreadsheets for the larger projects. This is only 5 years, so you can do it easily on the calculator. But if it is 20 years with difficult numbers in terms of cash flows, then you will have to make use of a spreadsheet, which is, let's say, Excel. And this assumes that the cost of capital is known, but in practice, cost of capital is just estimated. In your examination, they'll give you the cost of capital as 6% or 8% or 10%. But in real life, this 10% or 8% is just an estimation. It is not certain and it depends on particular assumptions, but market conditions change. Today, the RBI may have a particular repo rate, but tomorrow they may reduce the repo rate, which may have an impact on your required return. And hence, to tackle this problem, this may always require some sensitivity analysis. What is sensitivity analysis? You may say, okay, if my cost of capital is 10%, I am NPV positive. But what if my cost of capital increases to 12%? Am I still NPV positive or not? Or not? That is the sensitivity that you will be doing. So by now, what all have we discussed? We've discussed the concept of time value of money, that the date today is better than the date tomorrow. That is the time value of money, compounding, and the reverse of compounding, which is discounting, and the concepts of cost of capital and NPV. We'll go for a short break, and after a short 10-minute break, we will come back and discuss the concept of annuities and perpetuity. See you. Hello everyone, welcome back from the break. Actually, during the break, one of the students texted me on WhatsApp saying, but sir, 1.01 raised to 365 should be only slightly different that 1 raised to 365, right? Because sir, it is just 0.01. And similarly, 0.99 raised to 365 should be just slightly different from 1 raised to 365. I will tell you how much the difference is. If you just give 1% extra every day, at the end of 1 year, you will be at 37.78. 1 raised to 365 is 1. 1.01 raised to 365 is 37.78. And 0.99, if you keep reducing yourself or keep going worse by 1%, just 1% every day, you will be reduced to just 0.025 of your original self. And this is how much compounding matters. This is the benefit of compounding. This is the benefit of compounding. If you want to, by the way, remember compounding or discounting, if you want to remember the compounding or discounting method, just think of discounting as a time machine. Think of discounting as a time machine which brings back in year 5. If you have 5 lakh rupees, how much should you invest today if you want 5 lakh rupees at year 5? If you want 5 crore rupees at your retirement, how much should you invest today? That is nothing but discounting. That is nothing but the time machine. Think of it as that 5 lakh coming to today, losing its weight. You in 5 years hence will be heavier than you are today in terms of money. 5 years hence, that 5 lakh rupees will be heavier. How fast does that 5 lakh lose weight in the time machine depends on the speed of the time machine. What is the speed of the time machine? The speed of the time machine is nothing but the cost of capital. Capital, which is what we had discussed over here. Higher discount rates means smaller present values. You will be lighter today if the time machine moves fast. How will it move fast? Because the cost of capital will be higher. Let's quickly jump to the next concept of annuities after already having discussed NPV, compounding, discounting, and time value of money. What is an annuity? The word annuity is derived from the word annual. Annual means yearly. Think of you as subscribing to a yearly subscription of Netflix. And if you keep subscribing year on year for 10 years, what is the value of this today? That is nothing but annuity. Example could be, or rather first the definition, it is series of equal annual cash flows. It is a series of equal cash flows. Remember the word equal. It is a series of equal annual cash flows at regular intervals. Think of it as similar to EMIs, which is equated monthly installments. EMIs are nothing but equated monthly installments. Just like they are monthly, similarly, if they were to be annually, then they will be annuities. The same cash flow at a regular interval, which is typically annually, is called annuity for a fixed number of years. Assume annual lease payments of 50,000 for 5 years. So 50,000 is the amount of annuity, which is the equal cash flow every year for a fixed number of years, which is 5 years over here. The annual loan repayments of 25,000 for 10 years could be another example, or annual equipment service. Any equipment, any car will require annual service. The fixed number every year for 7 years is also an example of annuity. So over here, what is the annuity factor? There is a particular annuity factor which helps you to discount future equal cash flows to get to the present value. What is that annuity factor? That is nothing but an addition of each year of discount rates. But instead of using each year of discount rate, you will be using that annuity factor, and that annuity factor AF, you will just multiply that annuity factor annuity factor to reach to the present value. You will multiply it to the annual payments. So in this case, the annual payment is 50,000. You will multiply an annuity factor to reach to the present value today. Sir, what is annuity factor? How do we calculate it? Keep the formula aside for a moment. Keep the formula aside for a moment. I will explain you a very simple. Actually, why don't you look at the example and calculate it using the example. Annual payment of 3,000 for 3 years at a discount rate of 8%. Okay, how do we do it? Year 1, your cash flow is 3,000 into the discounting rate. What is the discounting rate of 8% at the end of year 1? Of this 8% at the end of year 1, 1 divided by 1.08 is the discounting rate, and this number is nothing but 0.9259. What is it for year 2? Year 2, 3,000 into, what is the discounting rate? It is nothing but 1 divided by 1.08 press equal to twice, and that number will be 0.8573. Press it for the third time, press equal to for the third time, and you will get the discounting rate for the third year. Let us multiply these one by one. So 0.9259 into 3,000 will give you 2777 rupees. 3,000 into 0.8573 will give you 2572. I hope you are calculating this with me. Please keep using the calculator with me. Otherwise, it will be very difficult for you to follow in terms of how am I calculating. For the third year, 3,000 into 0.7938. How did we arrive at 0.7938? 1 divided by 1.08 raised to 3. You press equal to thrice on the calculator. You will arrive at 2381. Now, the total of these three will give you your present value. What is the total of these three? 2777 plus 2572 plus 2381 will give you your present value, which is approximately 7730. 2777 plus 2572 plus 2381 is approximately 7730. Now, annuity factor is nothing, the present value of annuity is nothing but the annual cash flow. What is the annual cash flow? The annual cash flow over here is 3,000 rupees into annuity factor should be this. What is the annual factor? Annuity factor is nothing but 0.9259, which is the first year discounting rate, plus the second year discounting rate of 0.8573 plus the third year discounting rate of 0.7938 gives you your annuity factor, and over here your annuity factor is 2.577. And if you multiply this 2.577 by 3,000, of course you will end up getting the same answer as this. There is a formula for the annuity factor so that you can make the calculations in a much easier manner. The formula is annuity factor is equal to 1 minus bracket 1 plus r raised to minus n. You remember this 1 plus r raised to minus n. 1 plus r raised to minus n was multiplied by the future value. This was the formula of discounting rate. This was the formula of nothing but discounting rate. R is what? R is your cost of capital, and then this is 1. So in our example, if we were to do the same math, what is 1 plus r raised to 1 minus n? 1 plus, what was it? R was 8%, so 0.08. What was n for you? N was 3 years. And divided by, the whole thing divided by 0.08. Now let us solve it step by step. 1 divided by 1.08 raised to 3, which is 1 minus, is equal to 1 minus 0.7938 divided by 0.08, which is nothing but 0.2062 divided by 0.08. That again gives you the answer of 2.577. So the formula of annuity factor is nothing but it helps you reach the same answer as you would have reached otherwise by calculating the discount rates for each year payment. But rather than doing it for each year when the cash flows are the same, you simply use this formula, which is 1 minus 1 plus r raised to minus n, which is the discounting factor, the whole thing divided by your discount rate. That is the formula of annuity. So this is one calculation instead of 7 individual, or in this case it is 3 individual discounts. For 3 years you would have had to do it thrice. Instead of thrice, you have to do it only once. Similar to the present value tables, the institute will also give you annuity tables, which are also called as cumulative present value. What is cumulative present value? Addition of 1 plus 2 plus 3 is cumulating all the present values. This will give you your pre-calculated annuity factors. How do you have to use it? You have to identify the project life. What is the project life? It is 3 years for us. What is the cost of capital? The cost of capital is 8%. Now you look at the intersection of the year row and the rate column. This is the annuity table. This was the present value table. What does the present value table show? Present value shows that the value of 8% in the third year is 0.794. In the first year is 0.926 and second year is 0.857. This is the present value table. But we have to refer to the annuity table. And hence we will use the same methodology, but we will use the annuity table period 3% 8, and hence the answer is 2.577. Going back to our answer, what is our answer? Our answer was also 2.577. In the examination, you will be given the annuity table, but nevertheless, you should know how to use the calculator to find out the annuity. Going to the next concept of perpetuities. By the way, if you have any questions, feel free to put it on the chat box. Just checking if there are any outstanding queries. Sounds good. There being none. Coming back to the concepts. Perpetuities, which is if you get infinite cash flows. Sir, ऐसी कोई scheme बताओ ना. Please tell us a scheme which will give us infinite cash flows. Let's assume there was a bond. Actually, what is the meaning of perpetuity before that? It is the constant annual cash flow. It is a constant annual cash flow that continues indefinitely, that continues perpetually or in perpetuity, forever, indefinitely. That is, the company is saying, I will live forever, much more than what you, Divesh sir, will live, what this me as a student will live, and how long this syllabus lives. The company will live for much more longer. What are the examples? The example could be of a perpetual bond which is paying fixed annual coupons. Let's say there is a perpetual bond of 1 lakh rupees. You invest 1 lakh rupee today, it will keep giving you 10% per annum for a lifetime. It will not return you your capital. It will keep giving you 10% for your lifetime. The second example is the permanent rent on property. Assume you have a property, you put it on rent, you will keep getting rent every year until you own that property. That is another example. A third example is of a dividend paying company, where this company says, Divesh sir, I will live longer than you live, I will live longer than your students, and I will live longer than this course or this subject ever lies. So what is the formula? The formula is very simple. It is nothing but the annual cash flow. What is the annual cash flow? The annual cash flow, if I was to invest 1 lakh rupees at 10%, it would have been 10,000 rupees. The annual cash flow is nothing but the 10,000 rupees divided by RR is the discounting rate of 10%, is nothing but 10,000 divided by 10%, which is the 1 lakh rupees. So for annuity, the present value is nothing but the annual cash flow divided by the discounting rate. How is this formula arrived? If you actually take if you actually take 10% and keep doing it till perpetuity, if you keep doing it for 20-30 times, you'll reach to a number which is very close to 1, and hence 1 by r is the perpetuity factor. So the formula of perpetuity is very easy. It is nothing but the annual cash flow divided by the rate. So in this example 5, it is 3000, which is the annual cash flow, divided by 10% of your discount rate. So present value is 30,000. Your present value of perpetuity is 30,000 rupees. But what if, sir, you gave an example of rent. I will keep getting higher rent every year that I keep owning the property, right? I will not keep getting the same rent. I'll keep getting higher rent. What do we do then? Okay, if there is a growth of X% in your rent, let's assume the discounting rate is 10% and the growth in your rent every year is 4%. What do you do? Then the formula is, what is the rent that you receive in year 1? Let's assume you receive a rent of 10,000 in year 1. Then the formula is the cash flow that you receive in year 1 divided by the growth divided by the discount rate, which is 0.10 minus the growth rate of 4%, which means 10,000 divided by 6%. So the present value of this number will be 1,66,666 rupees. Present value will be 1,66,666 rupees. But in this situation, your R, which is your discount rate, must always be higher than your growth. Your R must always be higher than your growth for the scenario where you have a constant growth rate. You have a constant growth rate of 4% every year and your discounting rate is 10%. Then your formula is cash flow at the end of year 1 divided by the discounting rate minus your growth rate. This is called as nothing but the growing perpetuity factor. So in this example, let's say if you are still getting the same 3,000 of annual payment, but now instead of 10% discounting, this 3,000 keeps growing at 2% annually. So what do? You say, sir, cash flow at the end of year 1, which is 3,000, divided by my discount rate of 10%, which is R, minus my growth rate of 2%, which is my G. That gives me my 3,000 divided by 8% gives me my 3,000 divided by 8% gives me my answer on the present value for perpetuity, which is growing forever. So if it was not growing, the answer would have been 30,000, but because it is growing, my answer is 37,500. Now let's talk about advanced and delayed annuities or perpetuities. What are advanced annuities? Your standard assumption since we started this chapter is that you will receive cash flow at the end of year 1, not today, at the end of year 1, right, which is T1. But what if in a situation there is some advance amount that you are getting today? There is a signing bonus that you are getting of the rent. You are getting an advanced rent every month. In the same example, you're getting an advanced rent every month, then your timelines do not start from T1. They actually start from the T0, which is the day you are standing on, which is today, and the remaining payments continue at T1, T2, T3. How do you calculate the annuity or perpetuity today? Then what do? You calculate your present value as if you are doing it as n-1 years. If for example, your annuity over here, what you're calculating for 3 years. But for 3 years, you get the first year cash flow on day 1. Then instead of 3 years, it will be 2 years. Why will it be 2 years? Because you're standing today. You will get 3,000 rupees today. You will get 3,000 rupees at year 1 and you will get 3,000 rupees at year 2. While it is 3 years, but your first amount you've gotten today and you will get the last amount at the end of year 2, which means you will calculate the present value as if you are discounting only for 2 years. So you will do the annuity for only 2 years. So your annuity will be for 2 years, and then you will add +1. So in our 3000 example, you will do the annuity for 2 years. I am doing it divided by 1.0, which was the example was at 8%. Example was at 8%. Yes, it was at 8%. So what will I do? I will find the second year annuity. I will find the, actually I want to use the table because that's how you'll be able to remember as well. Yes. What was this was the third year annuity factor. The second year annuity factor was 1.783. So we will use the 1.783 as the annuity factor. Coming back. Coming back, 1.783, which is the second year annuity factor for 8% annuity factor for second year. Effectively, this, if you multiply by 3000 into 1.783, this effectively is 5349. And to this you will add 1, and to this you will add 1, which means actually you will add 1 to this number. You will add 1 to 783. So your annuity factor now becomes 2.783, and you multiply your annual cash flows of 3000. So 3000 into 2.783, your answer is 8349. Your answer is 8349. What is the logic? The logic is the 3000 rupees on day 1 remains 3000 rupees on day 1. You will just take out the present value of the next 2 years and simply add the 3000 and simply add the 3000. Now, if you were to solve this example that I have given in the notes, if I was to solve this example, what is the annual payment for 600 for 5 years starting today? In the exam, they will clearly give you a mention as starting today. Starting today. They will clearly let you know that we are starting today at 10%. They will clearly let you know that we are starting today, which means that your 5 years becomes 4 years now. Why? Because you get 600 today. Year 1, year 2, year 3, year 4. You are supposed to get 600 payments. So effectively you are getting 1, 2, 3, 4, 5 payments, but the years will be 4. And hence you will discount only for 4 years at 10%. So what is the annuity factor for 10% for 4 years? Let us go back. So 10% for 4 years will be 3.170. And if you were to come back, then effectively this means the total here is 3.170. And to this you will add 1. Why do you add 1? Because the value of 600 on day 1 remains 1. So 1 rupee on day 1 remains 1. So your annuity factor now becomes 4.170. You will multiply your annual payment of 600 to this. So 600 into 4.170, which means 2502 is your answer. Any questions? I'll just check if there are any questions or queries before we keep going ahead. Any questions or queries? Seems like there are none. Sounds good. Coming back. So this is the concept of annuities where your first payment starts today, which is at T0 instead of at T1. Coming to advanced perpetuities where your payments start now. We said perpetuities, which is from 1 year from now you will start receiving the 10%. From 1 year from now you will start receiving the rent. But what if you start receiving the rent on day 1? What happens then? Then the same thing, which is you will calculate perpetuity as you would have. But you will simply add 1 to the perpetuity factor, which is 1 plus, this is the perpetuity factor if you remember, and you will multiply the payment, So for example, if your yeah, so actually this is the answer. Instead of, let's say, 10%, or rather the 10% that I had calculated earlier, you get 10%, 10,000 every year starting today. Then 10%, this gives you 1 lakh, but you also get a 10,000 today. So your perpetuity factor is 1 divided by 10%, but which is actually 100, but you add 1 to that, so it is 110 into the 10,000 that you are getting. So the answer will change from 1 lakh that we had calculated earlier to 1,10,000. Now this was advanced perpetuities where your payments were to start from year 1. Now what if your annuities get delayed, where your payments don't start earlier but they start later? Let's say instead of year 1 they start in year 3. What have we assumed? We had assumed, if you remember, that all the cash flows start at year 1, which is all the cash flows start at the end of year 1. What if all the cash flows don't start at year 1? Hypothetically they start at the end of year 3. What do you do then? Simply, what do you do, sir? Okay, I will do the calculation at year 3, assuming year 3 is the present value. So calculate present value at year 2, because year 3 is 1 year. Year 3 is 1 year from year 2. You calculate present value as on this date. You calculate present value as of year 2, which gives you the value as of year 2. Now you discount this value to year 0. So effectively, if I was to draw a timeline, year 0, year 2, year 1, year 3, if your cash flows actually start from here, you will do the present value math here, which bring your value to year 2, and now this present value of year 2 you have to convert to the present value at the start of year 0. So you'll have to discount it back to year T0. How do you do this? Let us take an example. You will get 200 annual payments. Yeah, at some point my students will start telling me, sir, you keep saying we will get 200 annual payment and 10,000 annual payment and 1 lakh annual payment. Please give it to us. That is after you clear ACCA, that you will get in your first job. But anyways, coming back, your annual payment will start for 4 years at year 3, which means at the end of year 3 you'll get something, end of year 4 you'll get something, year 5 you'll get something, year 6 you'll get something. So at year 2 you will do the math for 4 years. At year 2 you assume for a moment that year 2 is your year 0. You do the math for 4 years. How do we do it? We will say 1 divided by 1.05 for 1, 2, 3, 4. Press equal to 4 times. And do the total of this, which gives you your annuity factor. At 5%, the annuity factor is 3.546. Let us just check what is the annuity factor as per the tables. The annuity factor for 5% for 4 years, it is 3.546. So now if we go back, 3.546 into 200 rupees is the amount of present value at year 2. At year 2, your amount is 200. The present value is 200 into 3.546, which is nothing but 709 rupees approximately. Now this is at year 2. You have to bring this amount to year 0. How do you bring this to year 0? You'll have to discount this by 2 years. How do you do that? You will say, I will do, sir, 1 divided by 1.05, 1 year, and I will do it for 2 such years. So I will bring it back. So this number is nothing but 0.907. This is the discounting factor. Remember the formula of the discounting factor, which is 1 plus r raised to n. This is the raised to minus n actually. So because this is divided by, so 1 plus 0.05 raised to minus 2. This number is nothing but 0.907. You multiply this 907 by 709 into 709. What is 709? It is the cash flow at year 2. So you will bring it to year 1, year 0, sorry. This number is 643. So what is the $200 of annual payment for 4 years, pound of annual payment for 4 years, starting year 3? What is that number? The number is nothing but 643 rupees. How did we do it again? We brought it from year 2 to year 1. At year 2, we had already calculated a present value for the next 4 years. I think that summarizes all the discussion for today. Of course, we have one last topic for this chapter to discuss. Chapter to discuss, which is the concept of internal rate of return. We've already discussed NPV, we discussed time value of money, compounding, discounting rate, and the advantages and disadvantages of NPV. Also discussed annuities and perpetuities. We have one last topic to discuss, which is internal rate of return and the comparison of internal rate of return with NPV. But I will leave you with this today. Take a relook at these concepts and come tomorrow, the same time tomorrow, which is 7 p.m. We will resume again on YouTube Live. We will look at the concept of internal rate of return and we'll solve a couple of questions to summarize this chapter before we go to the next chapter. Thank you all for attending and hope you liked this video. For more details about this batch, you can look at the description how to enroll towards this batch. Any queries for all the students who've already enrolled, you can directly message me at WhatsApp. For those who've not, you can leave comments on the YouTube video, or you can also reach out to the BB Virtuals Global team based on the link and the phone number which is given in the description below. We'll come back tomorrow with a live again around this time, 7 p.m. And for any feedback, please do let me know in the comments. Do enroll for the batches. The time is running out for March 26 exams and beyond. All the very best. See you tomorrow.